Hello and welcome to this edition of CMS Forex News. I'm market analyst Nick Nassad. Today is Friday, February 13, 2009. The Eurozone economy contracted by the largest amount in at least 13 years in the fourth quarter. GDP was down 1.5% compared to the third quarter, which undershot expectations of a 1.3% decline. From a year earlier, GDP was down 1.2%, which is the first time since the euro was introduced that there has been a year-on-year drop in GDP. The recession here is forcing companies to lay off staff while consumers are scaling back spending in the face of deteriorating economic conditions. France and Germany shrank by the most in nearly 2 decades as well in the fourth quarter. The German economy shrank 2.1%, a grim figure for the final 3 months of 2008. That was the steepest decline since 1990. Expectations had been for a 1.7% drop. This follows a 0.5% reduction in growth in the third quarter. Since Germany is the biggest economy in the Eurozone, its worse than expected result was reflected in the weaker Eurozone GDP numbers. The GDP news from the Eurozone sent the euro-dollar pair lower after it had retested the level around 1.2940 at the start of the European session. The pair slid 120 pips to set a low at 1.2820, from which it rallied. The pair seems to be stuck in a consolidation pattern, as this week we have mainly seen sideways trading. The euro-pound fell in favor of the pound in the wake of the weak Eurozone GDP data. The pair slid 180 pips, finding support at 0.8830, which was a 50% retracement of the rise seen in the early half of the week. After testing support, though, the euro reclaimed the 0.8980 level. The euro-yen rose today as the yen gave up its gains from earlier in the week. Following a test of 115.75 yesterday, we've seen a 370 pip move, wiping away the decline on Tuesday, which was fueled by risk aversion following U.S. Treasury Secretary Geithner's unveiling of the U.S. Financial Stabilization Plan. U.S. consumer confidence took a big step backwards in February, the University of Michigan's Sentiment Index showed. The index fell from 61.2 in January to 56.2 for the mid-February release. Though the perception of current conditions improved slightly, there was a rather sharp slide in future expectations. That subgauge fell from 57.8 to 49.1. Inflation expectations over the next year fell to 1.6%, but inflation over the next 5 years is expected to be 3%, which was an increase. Just like against the euro, the yen gave up its gains from earlier in the week against the greenback. The dollar-yen pair bounced off its upward sloping line of support after testing the 90 level yesterday. The rally amounted to almost 200 pips and brought the pair back to its levels seen on Monday. The pound-dollar pair also saw a counter rally overnight, though after a 400 pip move that reached 1.46, the pair fell back down more than 200 pips. The pound came under heavy pressure this week and looks to close about 400 pips lower against the greenback from where it started on Monday. And a couple more bits of news. New Zealand retail sales fell more than expected for the December period. Sales were down 1% following a rise of 0.2% in November. Excluding autos, sales were off 0.6% from a month ago. Producer and import prices in Switzerland continued falling in January. The producer and import price index fell 0.8% on the month, which put the annual rate at negative 0.9%. The decline was much larger than expected and continues a 6th straight month of negative inflation. Import prices on the year were down 4.7%, which led the overall decline. Next week begins with a national holiday in the U.S., but some key pieces of news to watch out for in the beginning of the week include producer price data from New Zealand, consumer prices from the UK, and the German ZEW economic sentiment. The latter half of the week will bring consumer and producer prices from the U.S., along with the FOMC meeting minutes. And that's it for this week in the Forex markets. Thank you for joining us here at CMSFX.com, and from all of us here, we wish you a happy weekend.